Hi guys, in this video I'm going to show you how to make profits trading a bullish and bearish pennant chart pattern. Let's get straight into it. Hi guys, it's Any, aka the Not Trader, your friendly neighborhood swing trader, back again with another video. Remember to hit that like button, that subscribe button, and that alert button to get alerts on all my latest videos. I've got Facebook, Twitter, and Instagram at the Not Trader on all social media platforms. And if you check that description section below, you'll see a link to my mailing list. I've also got a Discord chat room called Pip Talks. If you check that description section below, you see a link to that chat room. It's free and it's just for all like-minded traders and investors to talk about everything and anything to do with trading and investing. I also share some of my trading tips and some of the positions that I'm in the Discord group. So join that today. Bullish and bearish pennant. I'm just going to show you how you can actually turn a profit by trading these. It's a really easy chart pattern to identify, and once you know what to look for when you see it, then it's a really easy way of making some quick profits, especially intraday trading, or if you're just trying to do some sort of quick scalping type trades. So I'll just get straight into it. So with a bullish pennant, what you're looking for is normally where price is coming from the downside in up, and then what it does is it ricochets from the top and it makes higher lows and lower highs. So it's almost like a little bit of like a converging wedge. The only difference is that this is normally for shorter time frames that you normally see these at. So it will make higher lows and lower highs. So it'll go up, down, and then this will be higher than the previous one, this will be lower than the previous one, down, up, and then as it starts converging into a single point, it will have to make a decision. Now if it's a bullish pennant, then what's really important, you need to know that it's coming from the downside. So the fact that it's coming from here means that you know that it's going to break out to the upside. So what you want to do here is try and, once you see that price is converging, you can take a position probably at one of the low points here. So this is probably where I would take a position, somewhere like here. I'll take my position here, and then I would step my stop loss. I'll set my stop loss around here. So then that means that all you're risking is kind of, what have I done? That means all you're risking is just this area here, just this small area is what you're risking. This is what your risk is, but price can just kind of rally up. Now what I do is that when price starts rallying up, I will just move my stop loss. You could probably use a trailing stop loss, and you can just raise your stop loss, and then as price keeps rallying up, obviously price isn't going to go in a straight line. It's probably going to go like this, going to go up, then come back down again, then go up, and then come back down again. That's just normally how price moves, even if it's in a bullish move. So what I'll do is that I keep raising the stop loss. Whenever it starts reversing and then it starts picking up again, I'll move my stop loss just below that reversal. So I'll move my stop loss to somewhere like, oh, what have I done? So let's say this is it. Then I'll move my stop loss. I'll move my stop loss here, and I'll move the next one here again, and so on. So that means you lock in that profit. So if price just carries on going up, you keep raising it, and if it ever, when momentum dissipates and price starts changing direction, it will just hit your stop loss wherever it is at that point, and you can lock in those profits. But really, it's a great strategy, because the minute price starts climbing, you can basically raise your stop loss into like a into above the entry point, and then you're just in green territory. So then it's just a matter of how much profit you're going to make, as opposed to risking some of your capital. Now with a bearish pennant, it's basically the same thing but in reverse, really, to be honest. So so price will be falling into this position, and then once again it will be making lower highs and higher lows. So you'll see it go like that, like that, like that, like that, like that. And as it converges once again into like the single point, it will break out to the downside. And once again, same thing as before. What I like to do is let price get to the point, because it's all good and to say that, oh yeah, if you identify the bullish or bearish pennant, then you just want to enter it from like here or something. That's what some people ask me. But in reality, if it's just that, if the price is just here, then you don't really know it's a pennant yet. You need to see it like make a couple of low highs and high lows to really know that this pennant has formed. And then by that time, then once you're confirmed that it's a pennant, then you can actually take action. You can't preemptively take action here, because right now it doesn't, at this point it's not really any chart pattern. You can't really identify anything. So once again, what you do is that you set your stop loss around here, and then you'd enter your position around here. You enter your short position, so you short it, and then once again you just move your stop loss or set a trailing stop loss as price keeps falling and retracing, and just keep trailing it and just see how far it can go. Now I'm just going to show you this in a real life situation. It's all good and well showing it to you from like a very theoretical standpoint, but sometimes it's great to look at it from real life charts where you can see it happening in action. So right now I'm looking at the ASX, which is the Australian Securities Exchange. So it's the indices for the Australian major stock exchange for the top 200 companies within the ASX. Now what I identified on, let me go on, I think it was on the 15-minute chart, was a bullish pennant here. So as you can see, it never looks as pretty as it does in the textbooks, but this is why you need to be able to identify it. So when price came up here, it came back down here. Let me zoom in a little bit. Price came up, came down, came up, and then at this point, that's when I drew this line. But I wasn't sure if it was anything yet. I drew this one as well when it came and hit here. So now when it hit this point again, I was waiting for, okay, a breakout. Now what it did was that price sold off, reversed, and then broke out here. And at that point, I wanted to enter a long position. This is where I would have entered a long position. Now I would have, once you enter that long position, you can set your stop loss. What I would have done actually is set my stop loss just below here. So around, I'll show you. I'll give you a red line. So my stop loss, I would have set my stop loss around here. I would have entered around here, because here is where it would have broken out, and here is where the reversal took place. And then as price kept creeping up, what I would have done was I would have just let price carry on going up. When I saw this reversal, this first red candlestick, I would have moved my stop loss here. As price came going back up, it reversed here. I would have then moved it here, as you can see what I'm talking about, and you would have made a lot of profit and locked in quite a lot of profit and just accounted for the reversal. Then I would have moved it here and just kept letting it ride, let it go up, go up, go up. It would have gone up some more, and you can see this is a very profitable strategy if you see it right, get it right. It would have moved it here, would have gone up, then it come, and I would have been stopped out here. So in reality, you would have made about 63 pips and risked about, let's say 14 pips, 15 pips. Let's say 15 pips. So that's, what's that? Like 4-to-1 risk to reward. That's really good. And straight away, and with this strategy, straight away you would have been in the green basically from the minute you entered your position. You wouldn't have been in the red position at all. So this is a great, once you're able to identify bullish and bearish pennants, it's a really great strategy, and it's one of the strategies where it's very easy to turn a profit and not have to go through the emotions of some of the other patterns where you might end up going back into a red position and then going back into the green position. Because if you identify and you execute it right, you could be in the green position throughout the trade. So hopefully this was useful. I'm Any, aka the Knock Trader, signing out.